Hey everyone, once again, as I've said then in the previous video, that the next video that I will brought to you will be the video where we'll be able to do then the performance report. As we can see there, that's what we're going to do. I've used this exercise 11.10. You'll find that this exercise in the second version of your prescribed textbook. But you won't bother yourself then by doing so because you've got the exercise then in front of you. It reads, the information below is available for Schoolmeet Limited for 20 times 8. You've got a fixed or your static budget. Look at the capacity of then this budget. This budget then was planned with 1,000 units in mind. So they've decided that, okay, without those units, our direct material, it will be 15,000, indirect material, your 4,500, your direct labor will be 40,000, indirect one, 12,000, depreciation, which is a fixed item, 8,200, property taxes, gain is given 750, electricity is there, 9,500, and your production overheads 5,650. Then the following actual, take note of that, cost were incurred at 1,200, and there is a change now of our production. So you could see already here then we cannot be able then to compare and say, okay, let's take 15,000 and compare to 21,300 because the level of activity are not the same. So we can't do that. So we need firstly then to adjust our fixed budget. But we cannot simply go straight to our fixed budget. Hence, then we say that we close that gap by drawing up a flexible budget at a level of your actual output. So all costs excluding depreciation and property taxes are variable in nature. So they've made your life easy. This is then your first requirement to prepare a flexible budget at 1,200. Even if then they didn't mention that, we know that then we're going to prepare a flexible budget based on the actual output, because the reason is to compare now our flexible budget with the actual results. So let's quickly go and do then that A. So to do then that flexible budget, we've got then the fixed, then we're using that then to prepare our flexible budget. So the flexible will be at 1,200, and you've got your fixed budget, which is sitting at 1,000 units. So this is going to be your cost per unit. Don't know why now this. Other activity then that we have. So the first one, we're given the direct material. You've got, you've got then the indirect material. And we've got also then the direct labor. I hate what this stylus is doing because now. And also then the indirect labor. You've got your depreciation. You've got then also then your property. Taxes. We've got then the electricity and our production overheads. So those are the activities that we have. We've already told them in the exercise, if then you may recall, guys, going back to the exercise, that when we look at the cost that we have, then it was mentioned then to us that the depreciation and the property taxes, then they are fixed in nature. So simply then, before you can do then your calculation, you can make then your life easy by coming then to your fixed ones, because you know that, okay, these are the fixed, they are fixed in nature. I'm sorry for that. I was trying then to open this one. Right. So depreciation and property taxes, they are fixed in nature, so no need for calculation of a cost per unit. So we are going then to take then the same amount as they are. So your total amount here will be the same, 8,200. Excuse me. And your 750 on this side. And coming then to the direct material, we have then to calculate then the cost per unit. I need some space here so that I can show then these figures. So we've got 15,000 here, we've got 4,500 on this side, we've got 40,000 here, we've got 12,000 on your indirect labor. Depreciation is 8,200, not 500. 8,200, the same 8,200 we've taken then to the flexible budget. 750, electricity, 9,500, and you've got your production overheads, which is 5,650. Then what we'll do then, I will work out then the cost per unit. So it will be 15,000 rands divided by 1,000 units. That gives you 15. 4,500 divided by 1,000 units. You've got your 450. 40,000 divided by the 1,000, and that's give you 40 rands. 12,000 divided by that, it would give you 12. No need then to calculate then this. 9,500 divided by 1,000, it takes you to 950. 5,650, and then you divide with that, and it would give you 5 rand 65 cents. So that's your cost per unit that you have. So that's the first step then when we want to do the flexible budget. And after you've done this, you can be able to develop your flexible budget at 1,200 units. So you'll simply say 15 now times 1,200 units, and would it give you 18,000? 1,200 times 450. Then on this side we'll have 5,400. 1,200 times 40. That's your 48,000. 1,200 times 12. Then it gives us 8,000. No. It can't be 8,200. It gives us 14,400. Then again, then we go and say then 1,200 we multiply by 9.50, and it gives you 11,400. Excuse me. And 1,200 times 5.65, it will take you to 6,780. So that's going to be your cost. You can add if you want to show the totals as well. Not a problem. So that's your age, that is your flexible budget. Here on this side we have 95,600 as a total. Then when we add this one, it takes us to 112,930, and understandable so, because now that we've got extra 200 units there. So that's our flexible budget. By doing this flexible budget, we're preparing ourselves, colleagues, and so that we can able then to do the what you say then is your performance report. That is why we have then to start with the flexible budget, is to be able then to develop our performance report. Now going back and look at requirement B, determine the total variances at 1,200 units of actual output. Now it's easy then to do that, because we've got then both. You've got then your flexible budget sitting at 1,200. In other words, you've adjusted then your fixed budget by doing the flexible budget with the same level as your actual units. So that's the nice thing then about that. So that is why then we've got then this budget. So we'll move on now and develop then our performance report. So So now to do our performance report, you've got then your flexible budget. Now look at your flexible budget as you did it. On A, it was based on 1,200. And you've got your actual results. And they are also based to 1,200. Then that means then they are comparable. We can able then to compare the two. But I need some space there. I forgot that we do have the third one. I'm sorry for this. My stylus is acting up. So let's say then we have then the activity column. Flexible budget at 1,200. Actual also is based on 1,200. Then you've gotten your variance. Column. So that's how then you're going to draw up then your budget. Again, we look at your direct material, indirect material, direct labor, sorry, indirect labor. After the indirect labor, you've got your depreciation. After your depreciation, then this is your property taxes, followed by the electricity, and lastly then your production overheads. In the flexible budget, so you'll simply come then to your solution in your requirement A. So you take all then these values that you have here as they are. You don't change because they are based on 1,200. So you've got then that 18,000, 5,400 here, 48,000, 14,400, 8,200, 750, excuse me, 11,400 and 6,708 to give you that total of 112,930. Then the actual results is there given in our exercise, so we'll take them as they appear there. If you look at your exercise, these are your actual results, so we'll take them at these figures. So we've got 21,300, 5,600, 53,750, and your 15,200 here in your indirect labor. Depreciation will be your 8,200, and here we've got 820, 11,200 this side, and 7,400. So based on our budget, our fixed budget, so by developing this flexible budget, we're saying that ideally, if then our activity is 1,200, so our cost was supposed then to look like this. But unfortunately then this is what is then your actual results. So you need then to do then the calculations. When you look at then, we said, okay, in the direct material, the plans show us that we're supposed to sit at 18,000, but we are sitting at 21,300. So it means that then we've got an unfavorable result of 3,300. You can indicate then by putting then under the brackets, or you put then a U here. Coming then to indirect material is 5,400, but the actual result is 5,600. Again, unfavorable amount of 200. Indirect labor, the plan show 48,000, but the actual result is 53,750. Again, a negative of 5,750. Someone is going to be fired in this company, I'm telling you. Indirect labor 14,400, but the actual result is 15,200. So it's unfavorable of 800. Come to depreciation, because then a fixed amount 0, then is 0 is positive. Property taxes, again then the plan shows 750, but actually is 820, so you've got an unfavorable here of 70. Electricity 11,400, but the actual result is 11,200, so then this one is positive, favorable. 6,780, then your overheads, but the actual one is 7,400. So therefore we've got 620, which is unfavorable. So you can add then your negative and minus, and then what is positive, and it will show you a result of 10,540. And here you've got 123,470. So this is what we call it our performance report. Once you show then the variances, okay, we're sitting at 3,300 negative in your direct material. Then again in your direct labor, again that's another negative. But it doesn't end here. We need then to carry on and analyze this. Okay, now what's the cause? Why then we've got this? These figures, where did we go wrong? That's another answer then that we need then to provide them to the management. So it's not a matter of then showing them that, okay, look, you've got a negative results. Prove them to them. What's the cause? Because we said that this is a performance report. We need then to use this and then to do all the necessary adjustment, so that by the end or in the following production period, we manage then to fix whatever then was wrong. So you need then to do again some calculation and show them, okay, now look, this is where then all went wrong, and in your direct material, and you assist then the management with the answers that they will be looking for. So you have then to calculate, to do then some little bit calculations and on that. Okay, what will be probably then the cause of the variances and all the differences that we have here. So they trust you that you are going to then to be able then to assist them and help them then to come up then why we've got this negative 3,300. So if we single out then the direct material, we've got a negative 3,300. So there are two possible reasons, guys, why we've got this negative amount. So to do our investigation, we first look at then the price. We say that, okay, probably then it will be then the price from our suppliers, because remember we buy then the raw material. or the chances is now the change is on the quantity that we use then in our production. We ended up utilizing then more than what we were expecting then to use. So I'll simply assume and say, okay, let's first look at the price. We develop a formula then to calculate that, where we say that, okay, it's going to be actual price minus the standard price, and we multiply then with the actual quantity. So that's a formula then that we have. Unfortunately, when you look at this exercise, you don't really have then this price, but how much costed you then the material, and how much then will be costed you then the, what you call it, then your quantity then that you've used. So this is then the formula. I'll just assume then some of then the calculations then for argument's sake for us. So to simplify this, I'll just take then this total, or and simply say then to us, but okay, the material base then to the actual. We can work around this. Yes, we can. Because you've got, guys, and in your actual, then 21,300. And take that 21,300 divided by 1,200. Then it will show you that, okay, the actual price of then the material is 17,075. Standard price. So when we talk of then the standard price is what we've planned. So in other words, it's going to be your 18,000. 18 then we divide then by 1,200 units again. So this is then the planned one. Then it gives you a standard, because this information, it was then your cost per unit per static budget multiplied then by the actual results. Hence then we call it a standard information. So it gives you 15. So that's where you'll see then the difference of it. Then the actual quantity, and the actual quantity, let's say that, guys, then is 1,200 for simplicity reason. So you could see then from here, guys, you can judge, okay, now where then your answer will be. Actual price 17 rand 75, yet you planned 15 rand. So in other words, you went into your supplier with 15 rands in your pocket, hoping that you are going to buy then enough material then to produce 1 unit with this 15 rand. But they said, no, in fact it's 17 rand 75. So you ended up adding then the difference. So then hence then we said that's going to be unfavorable then on your side. So you've got then this minus 2 rand 75 that you have to pop in again, times then the number of units that you are looking for, because you are looking for 1,200. So you can see there what's the reason for this 3,300 unfavorable. So it's because of the price. We can simply say so. We can also just check then with the quantity. Here is our formula. Here we say now actual quantity minus standard quantity times then with then the standard price. So in this case, then we say actual quantity is 1,200 minus 1,200, which is your standard quantity again. Excuse me. So we'll take these quantities as they appear here as our quantities, but in some exercises then you'll find that also then they are different. So but in this case then I will take the times then the standard price then you've got 15. So it's going to be 0 here, because they are going to give 0 multiplied by 15, 0. So you'll simply then report to the management, okay, look guys, it's not that now we've got anything wrong that we've done. It's because then of the prices then with the supplier. Probably then you can justify that and go and check. Maybe then you ended up going for the good quality that costed you 2.75 more. Yet again then you've managed then to stay then, or then to do your production with your planned quantity that you said that you are going to take. Then probably they will be happy with that and say, okay, as long as we are using in the good quality, then we are fine. Then we move then again to the direct labor. Again, they need some explanation about what happens then with the labor. Direct labor, we can go and explain then that difference that we have there. Our direct labor is sitting at negative 5,750. 5,750. Now we need to explain, okay, what caused this 5,750? Then two reasons again is a time. So it means that it's a production time that may cause this. Then the second one, if then it's not then the production time that we've said that we are going to take. The second reason then on that labor will be the rate. Because you can have then your plan and said, okay, this is then the rate that I think that we are going to take, but then things can go then differently. So then those are the two reasons why then we can have ended up having then those variances when it comes into the labor. So let's go and prove. Let's take then the time. So with the time we said again now the formula will be your actual time minus your standard time times times then the standard rate. That's then the formula that we have. So looking at our actual time, with this information that we have here, we don't necessarily have then the time. So I'll simply assume and say that, okay, we assume that we are going to take then an hour then to produce a unit. That's my assumption. So if we are taking an hour to produce a unit, if then the units we produce then is 1,200, it means then we've used 1,200 hours minus another 1,200 hours times then the standard rate. Let's work out then the standard rate. To have your standard rate, you simply go back then to that information. Direct labor, you go then to your flexible budget. You've got 48,000 there. Divide that 48,000 by 1,200. Then it gives you 40. Standard rate will be 40 rands. So this one will end up with 0. So then we can say, okay, it's not the time. So chances are then it's the rate that causes then all then this difference. So again, I will say actual rate minus standard rate. Then we multiply that by actual time. Then the actual rate. The standard we already have there is 40. So let's go and work out then what will be our actual rate. Actual rate, you come then to this 53,000. 53,750, and you divide it by 1,200. Then it's going to give you 44 rand 79, or you can say 80. 44 rand 79. Times then the actual times, which is 1,200. Remember we said that we convert this in hours. the assumption was that we take an hour to produce a unit. So you could see again now, this was your plan, your standard rate. You plan then to pay your workers 40 rand for each and every hour they've worked, but the actual amount that you have to pay was 44 rand 79. So for whatever reason then that you have, you ended up paying then that amount. So you've got 4 rand 79, then a more, times now the number of hours, which is 1,200. Times then 1,200. Then it takes you then to that 5,750, which is unfavorable. So that's how then you are going to prove then this and to the management. So same thing then when it comes then to manufacturing overheads. If your manufacturing overheads are based on labor hours, you'll use then the same formula. It will mean that the reason for those differences then in your labor is your time and the rate. So you'll use that, the same formula as indirect labor. And what we've just done, guys, here, this is then our last chapter, which is chapter 16. And again, what we've also covered here, that's your chapter 16. So what is left then on my side is just to load the notes for you. So I'll load the notes for you then on this weekend. So by Monday I can do again 1 or 2 tutorials on chapter 16. But I've already finished and then talking about chapter 16 because we're going to do material labor and manufacturing overheads when it comes to the variance analysis. So this is your standard costing. Then so we've managed then to also cover it. So this will bring us now to the end of our syllabus. Thank you, and I wish you all the best as you'll carry on and do then your diplomas and whatever. I wish then all the best. I'll be still around and assist you with whatever. As you know that on the 19th we are going to write our final assessment. So I'm there then to assist you, which is going to be based on this chapter 11 and chapter 16 that we've just finished. Thank you very much.